Chapter 9 is also about capital budgeting. And in this chapter, we are going to learn how to construct the cash flows, which we used to produce NPV and all the other investment criteria. And also, we are going to learn how to analyze the risk in our capital budgeting plans and how to control the risk. First, cash flows. Previously, we learned how to calculate the net present value. So basically, we're going to discount all the future cash flows with a proper rate. And that discount rate is the cost of capital. And the cash flows here are not accounting income. The difference is mainly in the involvement of depreciation. If you look at the income statement, you have earning before interest and taxes, we call it operating income. EBT, we call it taxable income, and also net income. These income are all after depreciation expense is deducted. And depreciation here is not a cash flow. You see that the value of your machine actually got reduced as the year goes by. That's depreciation expense, but you don't see the cash flows being spent on the depreciation. So what would be the relevant cash flows here? Of course, you need to consider taxes, and you also need to consider opportunity cost and the side effects. The opportunity cost basically is the loss of revenue from skipping alternative projects. Let's say if you have an ongoing project makes $10 and you just replace it with another project that makes $15. Well, your cash flow here is not $15, it's actually 15 minus 10. You only make $5 more. In this calculation, you count for the lost revenue from the previous one of $10. That's the opportunity cost of the new project here. The side effect usually happens when a firm adopts a new line that contradict or help the existing project. If it's contradicting or have some damages to the existing business, we call it erosion effect. That happens when the new product reduces the cash flows of the existing project. For example, if I'm running corporation of a retail store, let's say Target, if I just open a new store 2 blocks away from my existing store, then you can see that my existing store would suffer a deduction of cash flows because of the new store got opened up. Okay, so that's called erosion. And there's also synergy effect that happens when a new product increase the cash flows of existing projects. So if I'm running a candy shop and then I just add another line of business for ice cream, and these two products will go well together, so they may create synergy. The irrelevant cash flows here are mainly sunk cost and financial cost. They are not the cash flows used in the NPV calculation. The sunk cost is the cost that has already happened in the past, the cash flows that occurred in year -1 or year -2. So in your NPV calculation, you do not count that. In your NPV calculation, your cash flows from today, cash flow 0, and all the way in the future, but not in the past. An example of a sunk cost would be a cost of consulting or cost of a market analysis or cost of a financial analysis. They help you. Definitely, they have value contribution to the business, but because these costs are happened a year before or years before the NPV calculation, so we do not consider that in NPV calculation. The financial cash flow is another part we do not incorporate in the NPV calculation. For example, interest paid to the debt holders and a dividend paid to the stock investors. Both interest and dividends are cash flows, solid money paid to the investors. However, they are not part of the cash flows in the NPV calculation. Does that mean we are not considering the financial cost? No, we still consider the financial cost, but we consider them in the calculation of a discount rate instead of the calculation of a cash flows. And again, the more cash flow, the more financial cash flow incurred here, then the more discount rate you would put on the NPV. That's a higher cost of capital. So you're going to discount NPV, discount the cash flows by more, then you would end up with less NPV. But the financial cost does not affect the existing cash flows. Okay, so how do we calculate those cash flows? This is in another Excel project. So there are several components for you to calculate separately. The most complicated one is the cash flow from operations or operating cash flow. You are going to get the earning before interest and taxes. You do not deduct interest, even though there could be some dollar figure for interest payment. We just skip that, we ignore that. All right. And for taxes, we definitely want to incorporate that and also need to add depreciation back. All right. You see, EBIT is an accounting income. It's not a cash flow income. EBIT is calculated after depreciation is deducted. So to recoup the non-cash effect from a depreciation, we need to add it back. Therefore, your operating cash flow takes this formula: sales minus cost. It could be both variable cost and fixed cost minus depreciation expense times 1 minus tax rate. Therefore, you have deducted the taxes from your cash flows. Then you add depreciation back. Alternatively, it could be sales minus cost times 1 minus tax rate, and then you add depreciation times the tax rate. So these two formulas are the same. I just single out depreciation. You see depreciation showed up on two places in the formula above. Now it's only one place in the formula below. Okay, and this is called a depreciation shield. As you can see, the more depreciation you calculated, the higher operating cash flow you would have. It's all because depreciation offers tax shield. If you have a more depreciation, you would have a less taxable income, then you pay less taxes. So that's why you have a more cash flows if depreciation is higher. And you also have a one-time lump sum capital expenditure. It's a spend upfront. And there's also some spendings on inventory. If you start a new project, you're going to build up some inventory. When you finish the project, that inventory is going to be liquidated and it will be recouped at the end of the project. And that is called a change in net working capital. For example, I'm operating a mall business. Okay, I'm having a shopping mall, and now I'm considering a new project. I want to add a jewelry store into the mall business. Okay, so to add that store in my mall building, I have to, of course, spend a lot of money for the place for renovations, and I'm also going to spend money for furnitures, and all of these spendings involves the fixed assets investment, so this will be classified as capital expenditure. And to run this business, I also need to build up inventory. I need to buy jewelries to put in the shelves, and that would require me to spend money. Let's say if I run this business for 20 years or so, at the end of the project, 20 years later, I will need to liquidate the project. So what am I going to do with the existing inventory? I'm going to sell them off. And then I will have some cash inflows at the end due to the liquidation of inventories. And here is an exercise, and you're gonna do this in the Excel project I assigned to you. So here you have a company that will purchase an equipment at $1.5 million, and it will be depreciated in a straight line method to zero book value over 5 years. The annual sales is $950,000 a year. The variable cost is 40% of the annual sales. The fixed cost is $100,000 each year. And the equipment after the project will be sold at 20% of its original value. So 20% of the 1.5 million, that's a 0.3 million. New net working capital will be required. That is a 10% of the following year's sales. So let's say if you are going to have a sale next year of $950,000, then today, this year, you're going to have 95,000, 10% of that as inventory for preparation. So you have to maintain 10% inventory ahead of the year for each year's sales. Okay, and then after 5 years, when this project is liquidated, when you will have no more sales, then the existing inventory will be liquidated, will be sold off, and you will get the money back. Okay, and you see the required return is 12%, tax rate is 25%, and there's no interest paid. Even though there could be, let's say, $10,000 inventory interest rate being paid here, you ignore that because when we're calculating cash flows, we ignore financial cost. Okay, so here is the first step you're going to do. Usually in the capital budgeting project, you need to list all the information provided to you. For example, cost of equipment, annual sales, ending book value, so on and so forth. And based on the cost of equipment, ending book value, and number of years, and you can calculate the depreciation expense on an annual basis. That's a $300,000. You're going to use the beginning value of 1.5 million minus ending value of 0 divided by number of years. So 1.5 million minus 0 divided by 3, so it's 300,000. And you should also realize there is a difference between this ending book value and the actual salvage value of 300,000, 20% of the 1.5 million. So when the company report to the IRS, they said that on the book, this machine will be worth nothing, okay, $0. But actually, they plan to sell the machine for $300,000. So that's a discrepancy between the actual salvage and the estimated salvage or ending book value. If that's the case, if the actual value is different than the book value, you could make capital gains. And the IRS will not let you go for free. You have to pay tax on the capital gains. So you see that the salvage value, $300,000, is above 0. So that means you make a $300,000 capital gains, and you're going to pay tax on it, 25% of it. And if, for another case, let's say your ending book value here is 500, and your salvage is 300, is that capital gain? It's actually capital loss, all right? And if you have a capital loss, you would earn tax credit. After you sort out all the information, you are going to tabulate the cash flows across years. You have 4 major components here. One is initial investment. That's how much you spend to buy the machine. And another is operating cash flow that is calculated by subtracting all the expenses from sales, and then you pay taxes to get net income, and then you add depreciation back to net income to get operating cash flow. Okay, so that's the most complicated component here. And don't worry, you're gonna do this in the Excel project step by step. The third component is change of net working capital. The name, okay, the definition of it should be the cash flow effect from change of net working capital. If you look at your net working capital here, it is 95,000. It is 10% of the sales in the next year. All right, you always maintain the inventory at $95,000 until the end of the 5th year. In order to increase the inventory from 0 to 95,000, you will need to spend $95,000 cash on it. So that's your spending at year 0. But for year 1, year 2, year 3, and year 4, your inventory is maintained at the same level, so there's no change, so you don't need to spend cash or receive cash for it. But at the end of year 5, inventory is gone. That means you're going to sell off all of this inventory at the end of year 4 for cash. Therefore, you're going to receive some of the cash. So that's the cash flow effect from a change of net working capital. The last component is called a terminal cash flow. It has 2 components. One is a terminal value of the machine. As I mentioned earlier, you're going to sell the machine for $300,000 after the project is done. Because you are making capital gains out of the sale, so you're going to pay 25% tax on it. That's $75,000. And then your terminal cash flow would be the actual sale of the machine minus capital gains tax. And after you combine all the 4 components, one for initial investment, second operating cash flow, then net working capital, then terminal cash flow, the total would be called a free cash flow. It's called a free cash flow because it is freed from the incorporation financial cost. All right, it has nothing to do with the financial cost like interest payment or dividends payment. The free cash flow at the very end will be the cash flows we use to calculate the NPV, IRR, and all the stuff. So the next slide basically shows you the result of our capital budgeting. So you see net present value, profitability index, all of them are here. It is worth mentioning that to calculate a payback period and discount payback in years, you have to take additional step. you need to find the cumulative free cash flow at the year end. So you will tell whether it's running a deficit or running a surplus at the end of the year, from year 0 all the way to year 4, year 5. And for discounted payback, you need to discount each of the free cash flow in the future, and then run the same process again to get the cumulative discounted free cash flow, and then judge whether the money, the initial investment, is a payback after a certain amount of years. The next topic is a modified accelerated cost recovery system, or MACRS. It is a depreciation system designed by the Internal Revenue Services, or the IRS. So basically, the firm, if they adopt this system, they don't have the freedom to define the ending book value by themselves. So the IRS will make the number for you. For example, if you have a 5-year asset, like in this case, the equipment will last for 5 years. These numbers here in the column stand for the depreciation percentage for a 5-year asset. So in year 1, the depreciation is 20% of its original value. In year 2, it got accelerated to 32%. In year 3, it's 19.2%. And you also have depreciation expense in year 4 and year 5. Well, you may wonder why I have 6 numbers for a 5-year asset, or 4 numbers for a 3-year asset, or 8 numbers for a 7-year asset. You always have one more number, okay, one more year for the depreciation. The last number here is the percentage, okay, of the ending book value. So after 5 years of depreciation, you will have a 5.76% left as the ending book value. So it is specified by the IRS. As you can see, if you add all of these numbers together, that is 100 or 100%. And take the 3-year assets, for example. After the first year, the depreciation is 33.33%, or 1/3. Then the second year is 44%. In the third year is roughly 15%. And after 3 years of depreciation, the leftover, or the ending book value, is 7.41%. You are required to know how to use MACRS in a capital budgeting table. Back to the original example, it's the same example, and you can see that everything else would be the same. If you adopt the MACRS for depreciation, then the ending book value will change, okay? Instead of a 0 ending book value as the company originally reported, it should be 5.76% of the original value, 1.5 million, okay? And that 5.76% comes from this MACRS table designed by the IRS. So that's the very last number in the column. That's the percentage of your ending book value. All right, and for the annual depreciation expense, it's not a constant anymore because you're not using straight line depreciation method anymore. You are using MACRS, and you're gonna use the percentage given by the IRS, and use the percentage multiplied by the 1.5 million, the equipment price, to get the depreciation in dollar figure for each year. 20% times 1.5, that's 300,000. 32% times 1.5 million, that's 480,000, so on and so forth. And then based on that, you're gonna get a new operating income, new net income, and then you're gonna add depreciation back to get the new operating cash flows. And for the terminal value here, yes, you are still selling the machine for $300,000, but because you have a different ending book value, your capital gain is different. Instead of making $300,000 out of 0, you're making $300,000 based on the $86,000 ending book value under MACRS. So your capital gains tax would change as well. So your terminal cash flow is also different compared to previous case. The next topic is about risk analysis. There is always uncertainty if we are looking into the future. We have 5 years of cash flows, but none of us know that those numbers will for sure happen. Therefore, we developed several methods of risk analysis. The first one is a sensitivity analysis. So how do we conduct sensitivity analysis? We're going to do sensitivity analysis once for each variable. Okay, the first step is to define the variable in that deemed to be influential to your NPV or the value of the project. Let's say in this case we're looking at sales. All right. Originally the sales was $950,000, and now we wanted to reduce by 8% or any other percentage. If it reduced by 8%, so this would be your new level of sales, and then you're gonna find the NPV based on all the calculations. That's gonna be your new NPV under new sales. So if the sales drop by 8%, then your NPV would drop as well. Then you're going to record the change of an NPV and the change of a sales in percentage. Since the sale dropped by 8%, okay, we're going to put a negative 8 here. And the NPV, this is your old NPV, and this is the new NPV after the sale drops. And then you're going to calculate the number as a sensitivity. And how do we interpret this 14,999 or 15K? It basically says that if the sales increase or decrease by 1%, then the NPV would increase or decrease by $15,000. Okay, so that's how we interpret sensitivity. And the sensitivity analysis basically tells the change of NPV in response to a change of one particular variable. And you're going to do NPV analysis for more than one variable, not just the sales, but also variable cost, fixed cost, cost of capital, and so on. And you're going to plug the data, your result, in a sensitivity graph. The horizontal axis here stands for the percentage change of the variable, in this case, the sales, and the vertical axis here stands for the value of NPV. And you can see there is a positive relationship between change of the sales and the change of NPV. And it does not make sense if you just do sensitivity analysis on one variable. It would make more sense if you do it for multiple variables. And this is a chart of a sensitivity analysis with 6 variables in consideration. So you have a price here of your unit and of your product, and you also have the unit of your product. If you compare the sensitivity of a price and unit, you can see that the NPV would change more in response to price than it would change in response to units. So for the variable to change by the same percentage, the NPV would change by more in reaction to price change than in reaction to units change. Therefore, price is more important than units in terms of determining NPV. So you're going to look at the slope of all these sensitivity curves. The one with a higher slope or the steeper curve means that NPV is more sensitive to this variable. And if you compare fixed cost here and the variable cost here, they are both negatively sloped. So which means if a cost increase, NPV would be reduced. And which one is more important? It's clearly that variable cost, this curve is steeper, and the slope here in absolute value is higher. So that means for the same percentage change of the variable, variable cost change would cause NPV to change by more compared to fixed cost. So variable cost is more influential to NPV than fixed cost. The next method is called a scenario analysis, and this time we're not just doing an analysis on one particular variable, we're going to do more than one variables. For example, for the case before, and we can conduct a base case, best case, and a worst case. So we have 3 scenarios. In the best case, the sales would increase, fixed cost would decrease, and the cost of capital would be decreased. So you make more money and you have less cost. In the worst case, the sales would decrease and all the costs would increase. So that's pretty bad in all the 3 aspects. In the scenario analysis, you are going to incorporate the change of the variables in each case and then develop the NPV under each case and eventually calculate the expected NPV. So this would be the result for the best case. You can see that annual sales increased, fixed cost decreased, and the required return decreased compared to the original setting. And in the worst case, annual sales decrease, cost increase here, and also required return, which is a cost of capital, also increased. And then your NPV would be much lower. And then you are going to calculate the expected return of the NPV, okay, which is the probability times NPV for each case, and you're going to sum them up to get the expected NPV. And also you are going to know how to get the standard deviation of NPV based on the probability of each case, of each scenario, and the NPV output of each scenario. And you are going to conduct a separate analysis on the Excel project of this chapter. The last analysis method is called a Monte Carlo simulation. Essentially, it is a scenario analysis, but in this case, we're using the computer power to simulate a lot of scenarios, thousands or tens of thousands of scenarios. And under each scenario, we define the variables, and it's not just one variable, it could be multiple variables in your analysis. And for each scenario, we have a different numbers for different for the variables in analysis, and then you're gonna develop a different NPV. And then you're gonna analyze the distribution of the NPVs. This is a very advanced method. It was pioneered by the pharmaceutical companies in this country because that industry has a lot of risk and uncertainty, so they have to do a very good job in controlling the risk. And in the Monte Carlo simulation, here are the steps. Number one, you need to define your model. You will need to know NPV is a function of all the variables you need to consider and how NPV is determined by these variables. And the second, you need to specify the distribution of each variable. You can use a normal distribution, uniform distribution, triangle distribution. Those distribution you learned from a statistics class. And then you're gonna conduct simulation. So for example, if it is normal distribution, then there will be more simulated values around the average than away from the average. Okay, and then for each scenario, you will calculate the NPV, and you're gonna have thousands of NPVs or tens of thousands of NPVs depending on the number of your simulation. And then you're gonna analyze all the NPV output. So if you do a Monte Carlo simulation, of course, that's gonna be a lot of data for you to follow. The final goal here is to pull together all the NPVs and see their distribution and see how likely you're going to have a very extremely low value, and that's going to be your risk to control.